Later today, investors are going to be parsing through the Fed's minutes for clues on the path of interest rates. Joining us right now with her take on the markets is Alicia Levine. She's head of investment strategy and equities at BNY Wealth. And Alicia, thanks for coming in this morning.
Great to be in.
So we mentioned earlier in the tease that we broke the winning streak we've seen for the markets, but we are still talking about all three of the major averages, less than 1% from all-time highs. So I don't know if it's anything to write home about. What do you think about where we stand?
So, look, I think we're probably due for some digestion here just because it's been rather remarkable.
By that, you mean indigestion?
A little indigestion, but nothing serious, meaning that the fundamentals still support appreciation in the markets because, the main thing is the main thing, that the Fed is cutting into increased earnings estimates and what looks to be better than expected growth going forward over the forward 12 months. So you're in a situation where you're getting liquidity in the market, earnings are moving higher, the Fed is cutting, and equities just do quite well in that environment. And that's what we've seen really since that sell-off August 1st from that bad payroll report, and market fell 3%. Estimates of the Fed rate cutting cycle started moving higher, and there you go, the market took off, and we never saw that September slump. So, look, do we think we move higher into the end of the year? Absolutely. We think we move, we kind of melt up into the end of the year, but with some pullbacks along the way, probably driven by the news cycle, which, of course, is volatile and has been since January.
If you think we're going to melt up into the end of the year, are you telling people to wait for the pullback to buy, or are you saying go ahead and buy now because we think markets will end higher?
Look, we don't time the market, right? The big question for markets is there a recession or not?
Is there?
And we don't see a recession coming. I mean, that's really the deciding factor about when to add new capital. So we tell our clients you can't time the markets. You should get in over regular intervals if you have fresh capital. But the setup is quite positive over the next 6 to 12 months because of the setup of monetary policy and fiscal policy. Because even the concerns over a K-shaped economy and part of the earners, the lower income earners not doing well and living on credit, well, fiscal is coming to the rescue, the first 4 or 5 months of the year in 2026 with about $150 billion of stimulus coming through the tax code and refunds. And so you wind up supporting areas of the economy that are not doing as well while you've just given corporates a tax break and you have the Fed cutting.
Yeah, is all that inflationary, though? Like, if you look at every one of those things you just ticked off, it seems like it would be inflationary?
It could be inflationary. I would point to the fact that productivity looks to be increasing. If you have fewer workers that you're hiring, and yet you still have output, it's by definition productivity is getting better, and productivity does mean that you have lower inflation. I think it's unclear. I think it is noisy. And we're going to lap this conversation at some point next year in the second quarter of 2026. And in some ways, fiscal policy is meant to support that into that when you lap it. And then you no longer have those higher than expected inflation reads.
The setup you describe absolutely is what the market's been riding, right? This idea that the economy is sturdy and we're getting Fed rate cuts. I've been watching, though, the consumer cyclical groups that have been leadership for most of this year. And in fact, was one of the best kind of bullish talking points was, yeah, sure, we're worried about jobs, but look at the consumer discretionary stocks. They've faltered a bit. Housing-related, travel, some retail. I wonder if that's telling you something, or is it just that K-shaped economy?
So I think it's a little bit the K-shaped economy. I think that the reporting season that we had in August supported the fact that the consumer is doing better than expected, because most retailers said, look, we're doing okay with the tariffs. The high numbers are not actually what we're paying, and we're passing on maybe a couple percentage points in extra costs to our consumer and clients, but we're spreading it around the product line. So that's what we've heard. I think it has to be watched. I think if you start getting one of those situations where cyclicals are not performing, then the market's telling you something. We like to look at market signals, less so much the economic data, because in the end, the market's telling you earlier than the economic data what's happening. So that is definitely something to keep an eye on. Right now, you still have earnings moving higher. You have the 493 actually catching up with the Mag 7 in terms of earnings contribution by the second quarter of next year. That suggests a broadening of the market. Yeah. That's what we're seeing. So until we hear otherwise, until we're sitting with a recession, we don't see the issue.
There's always next year.
There's always next year.
Because it was supposed to be this year, but yes.
Well, that's the thing. I mean, in the end, the expectations for recession were in 2023.
Yeah.
It didn't happen. Recession was the second half of the year because of the tariffs. It didn't happen. Corporate America has a very interesting way of taking the conditions on the ground and moving forward and adapting, and I think that's what we've seen. It's been quite extraordinary, actually.